Hello. Do you remember the Pharma Bro, also known as Martin Shkreli, the CEO of Turing Pharmaceuticals? Well, to jog your memory, he was the one who was questioned by people like Bernie Sanders and other senators because he inflated drug prices. He was on TV with that smug look, and I just remember my friend saying he wanted to throw something at the TV because what this gentleman was doing was inflating drug prices not just by two or three times their original price, but in one case by a factor of 56. And people needed these medications, and people were just outraged because he didn't seem to care that the price was so high and so unaffordable for people. Well, today we're going to talk about Valeant Pharmaceuticals, who also inflated drug prices. We're going to go over how they have been through the lows with poor CEOs, poor decisions, and how they're making a comeback, what they're doing now. And we will present to you many different factors, including financials, on what they're doing. And my team is made up of Kara Dorr, Craig Dalbo, Alex Fecci, and myself, Tony Credelli. Our team will be presenting on Valeant Pharmaceuticals, who is known as Bausch Health Companies. And we would like to talk about specifically how the company had many struggles, how they are trying to rebound from some of these debacles, and what other companies can do who are in similar situation of struggles can do to get out of it and succeed. We will go over the background in many acquisitions of Valeant. We will talk about its ethical concerns and the scandals that we alluded to in the intro, how it inflated drug prices. We will talk about some of its CEOs, the past ones who have made some pretty big mistakes, and present CEO who is trying to correct that and bring the company back and be a good, profitable company. We will go over the recent performance of Valeant, talk about how it's doing right now, and also give you our evaluation to see what we think of the company, and also to help give you a future perspective of where they may go. When we think about a successful company, we think of companies that are profitable, that make its shareholders happy. And to do this, there are some factors that we feel strongly contribute to these good companies, these successful companies. And keep in mind, if a company is weak in some of these areas, they may fail. They may not be around long or continue to struggle throughout the years. So first we look at leadership, usually the CEO. What is the strategic direction of the company? How are they leading and motivating the people? This is a very big factor to successful companies, and we'll go over that with Valeant. We also talk about the finances. If a company is making good, sound decisions, it can be profitable. If it's taking too many risks or it just doesn't have its finances in order, company will probably have a lot of issues going forward and may not make much money. We also talk about playing by the rules. Company that is always in trouble, trying to be fraudulent, or just having the government on them, they're not destined to last very long. So they need to be careful that they're doing everything correctly. We've talked already about fraudulent cases, and so we don't want that to be something the company does. They need to be strong and have a good understanding of how to play by the rules. Also, ethics. We already mentioned how companies inflate prices, Valeant being one of them. Well, this creates a bad image by people. They don't want to associate with this company if they don't have to. And also the people working for the company may not want to be there longer. They may leave. So ethics are very important. And then, of course, corporate social responsibility. If a company has bad ethics, is just known to be a company that nobody wants to really work for, or has a bad image, this gets into the media very quickly these days. Technology is incredible. People know right away what is going on, the negativity that is going on with the company. So this is something to be mindful. And so we're going to go over these factors throughout the presentation, how Valeant does it, and how other companies can succeed in these areas and be successful as a company. Valeant was started by Milan Panic. Panic was from Yugoslavia but came to the United States at a young age and was living in California. He attended the University of Southern California and then, at the age of 30, decided to start his own company, of course, from his garage, like many other companies in California. The company was called International Chemical and Nuclear Pharmaceuticals. And when he began growing this company, he was acquiring drugs in the dermatology field. And then he had the help of a few doctors, three who are Dr. Roland Robbins, Dr. Weldon Jolly, and Dr. Robert Smith, helped Panic discover a new drug called ribavirin. Now, this drug was very helpful with the flu and also other viruses, and really helped propel the company when it came to its finances. From here, Panic began acquiring some other companies. Some of note are Galenica, which was a Yugoslavian company, and Panic also decided to acquire 75% of a Russian drug company called Octiobar. And then he continued with other companies as well and just started a trend of looking for different pharmaceutical companies or drug companies to acquire. The company started having problems when Panic made claims that the same drug that brought him success, ribavirin, could cure other diseases, one of which was AIDS. Well, this wasn't true, and the SEC wasn't happy about it, so they charged him with falsely promoting this cure. Then, from there, Panic continued to have battles with the FDA to have the drug approved to help with other illnesses and diseases. He did have a win. It was approved by the FDA to help with hepatitis C, but overall, he just wasn't making some good decisions for the company. And in 2002, the board of directors supposedly forced him out. Now, officially he retired, but many say that he was forced out. Right after he was gone, the company did officially change the name to Valeant Pharmaceuticals. And from here, they continued to struggle. In 2008, they decided to bring in CEO Michael Pearson. Now, Pearson was from McKinsey and Company, and he was well known as a pharmaceuticals acquisition expert. And so that's what he started doing. He started making more acquisitions, some of which were Coria Laboratories for $95 million, Dermatech, which is from Australia, for $12.6 million. Then he went on to purchase Dow Pharmaceutical Sciences and Technopharma, all in the year 2008. Moving forward a couple years, the company decides to get into a merger with BioVal. Now, BioVal, there's a reverse merger where BioVal purchases Valeant, but BioVal was involved in an accounting scandal in 2008. And so they decided to keep the name Valeant, keep Pearson on as the CEO. But this, as we mentioned before, gave some problems to Valeant and now BioVal. The merger there started having negative impacts on them. And so finally in 2011, the accounting scandal is resolved, but the problems aren't necessarily over, although the acquisitions continue. So they decide to buy PharmaSwiss for $481 million. And then they purchase Sanitas in Lithuania for $500 million. Now, there was one very good acquisition, which was Bausch & Lomb from Warburg Pincus for $8.6 billion. This did help, as we see in the future. The name was changed to Bausch & Lomb because they were more of a positive known company with good results in the past. But these acquisitions sometimes fail. They attempted to purchase Allergan in 2014, and that failed.
In 2015, Valeant began quietly increasing the prices of their drugs. For example, their diabetes drug went from $572 to over $3,430. And when they did this, and when any prime drug manufacturer increases their prices, the wholesalers who are contracted to distribute the drugs must pay a price appreciation credit to the prime manufacturers. And this ensures that the price increase or the profits from the price increase go to the prime manufacturers versus the wholesalers. So Valeant received a lot of price appreciation credits because of their increased prices. Normally, when a drug company does this, the credits that they receive are not a significant amount. But in Valeant's case, they played a huge role in their operating cash flows. For example, in 2015, out of their $562 million operating cash flow, $138 million of that was from just price appreciation credits. And because of that, their stock price started to surge. In August 2015, Michael Pearson announced a fourth consecutive quarter of more than 15% growth. However, the success did not last. Ultimately, Pearson was fired, the stock plummeted over 90%, and this just goes to show that their strategy of buying drug companies and jacking up the prices was ultimately a dubious one at best. The fall of Michael Pearson began in 2016 when he was subpoenaed by a congressional committee that was infuriated over his price gouging strategies. In April 2016, U.S. lawmakers criticized Valeant's approach of buying older, niche drugs and driving up their prices post-acquisition. For example, there was a patient named Berna Heyman who testified that her yearly medication costs shot up from $700 to more than $10,000. According to research by sector and sovereign research analyst Richard Evans, Valeant raised its prices on all of its newly acquired drugs by more than 40% between October 2014 and October 2015. Pearson ultimately expressed regret for his price hikes and said that he was too aggressive. In the end, he was replaced by Joseph Papa, who at the time was CEO of generic drug maker Perrigo. But prior to that, he had worked for it in the pharmaceutical industry for over 15 years, including Watson Pharmaceuticals, Cardinal Health, and then Perrigo. Some of his first initiatives after he joined Valeant included expanding their sales force to have more face time with primary care physicians, increasing research and development, which Valeant had previously not been doing, as well as paying down the company's mammoth $30 billion in debt. In August 2016, Papa committed to paying down $5 billion of that $30 billion. He planned to do this by divesting a number of their assets and focusing on Valeant's core businesses.
Moving forward, in early 2018, Joe Papa and his leadership team made the decision that they needed to rebrand the company. So as part of that rebranding, they decided to change the name of Valeant from Valeant to Bausch Health Companies. And they viewed this as a major step forward in the transformation of the company. And one of the reasons that Joe Papa cited for doing this was that the Bausch name embodied the rich history of innovation, fortitude, and dedication to patient health, and these qualities formed the foundation of who they were today. So they thought that associating the company with the name Bausch, which is short for Bausch & Lomb, was a good rebranding strategy. And also as part of that rebranding strategy, they created a new website. They had all new imagery for it and for their company name, and they began trading under a new stock symbol, which was BHC, which obviously stood for Bausch Health Companies. So as you know, rebranding is a way to move away from things like a bad reputation, scandals in the past. But interestingly enough, not everyone was on board with this name change. Like consumers, when they see a new name, they may not associate it with the old name Valeant. But Wall Street has a long memory, and even Emma Court of MarketWatch.com said that any name change has to also be accompanied by a fundamental change in the way the company is run. So that was an interesting side note that even though a rebranding of a company might happen and consumers might not realize that happened, Wall Street knows and remembers, and so Wall Street looks for a fundamental change in a company before they will start being bullish on that company's future. So now let's talk a little about progress since the name change. So despite all the changes in the company, the leadership changes with bringing Joe Papa in, the strategy focusing on developing their core businesses and their debt reduction, there's really been little growth in their market cap from July of 2018 to present. In fact, if you look on the graph in the slide, it's a graph that shows BHC's and Valeant's, formerly Valeant's, market performance compared to the S&P 500, and also a group of their peers. So there's 12 different peers in the same pharmaceutical business that graph tracks, and you can see they're, from 2013 to 2014 they're tracking real well, and then of course the scandals that we told you about hit, and their value actually went down a total of like 90%, down to very, very, very low. And in this past year, you can see that it's been pretty flat. In fact, on July 1st, the BHC was trading at $23 a share, and as of April 30th, at the close of trading on April 30th, so it was trading at 23.09. So pretty flat. There were some ups and downs during that time. At one point, they went up to almost $30 a share, but as an overall trend, they're flat. Still, they're continuing to focus on streamlining their business, reducing debt through consolidation of their core businesses, and by paying down high interest rate debt with cash on hand. In fact, in 2018, they paid almost $1 billion worth of their high interest rate debt down out of their cash on hand. So they're really focusing on getting their capital structure aligned a lot better, and getting their financial health in order so they can move forward. Another area of focus for Joe Papa and the Bausch team is what they call their Significant Seven, and these are a list of 7 core products that they're manufacturing, that they're increasing sales on. In fact, they expect these Significant Seven to bring in over $1 billion of sales revenue combined by the end of 2022. So they're really focusing on that core strategy and their core capabilities, and reducing that debt. Another, in terms of where they're going in the future, one indications are that they're getting healthier as a company. Wall Street is starting to see them as a company that is not associated with scandals. In fact, Zacks has them rated as a number 2 in their rating structure, and that means that they're rated as a buy, not a strong buy, but a buy. Whereas before they were not, they were rated lower than that. So the market analysts are starting to look more favorably on them. They're expecting the May 6th earnings news to be positive, and along with the fact that they've been able to reduce their negative price to earnings ratio. It was at like negative 11. I think at the end of 2018 it was down to minus 0.98, and they're expecting to turn a profit in 2019 and going forward. So all in all, the outlook and progress since the name change has been positive. The market's starting to view them positively, looking at them as a company not associated with scandals, and that's a huge deal for a company to overcome that kind of reputation and move forward. So we're expecting good things to come for Bausch.
Okay, so on to the valuation. Before I get too far into that, I just thought it was interesting to see this graph. So this is the area that Craig showed you on the last slide, which is Valeant, and then here's the S&P 500 for comparison. So this is what happened the last few years since their big problems. But I thought it was interesting to also see the big climb that they had up until then, when they were making the big acquisitions, inflating prices. So it's a pretty staggering graph when you think about it. And so I thought that was interesting to just put a full picture display on for you guys. And so onto the valuation, what's this company worth? Obviously, you buy a company because it makes money. What is this company worth? So volatility was a consideration for us. Obviously, just looking at this chart, there's been volatility, and there still is some moving forward. There's a good many factors that we'll talk about in a minute. And so we had to take that into consideration. So fundamental changes in the company as well. There's a new CEO, essentially a new strategy. They're not taking any of the risks that they were taking before. They're more so looking to set up for long-term growth. We have to consider that. As far as the name change goes, I don't think that has a huge effect on the valuation. Wall Street's not dumb. They know it's Valeant. Purchasing manager for Vanguard buys a good bit of Valeant stock, not Valeant anymore, Bausch Health Company stock. They're not going to look at this graph from here on out, since the company was renamed, and be like, oh man, where did this company come from? I don't know, but they look good. Let's buy some. They have good growth potential. I mean, they're not dumb. They know it's value. They know that stuff happened. And so, I mean, they're really not hiding anything, at least from Wall Street. It helps the public image, but that's about it, in my opinion. For new products, they have 10 new drugs that were approved by the FDA in 2018, so that's great. Hopefully, they'll be successful. And then again, also reducing debt. They cut back on $1 billion of high yield debt. Emphasis on the high yield. That's great. They were able to pay off $1 billion of that. But at the same time, they're a company that has revenues around $8 billion a year, market cap around $8 billion, and they have $25 billion in debt. That's a big number. They could be in some trouble there. It's not life threatening, but it's definitely something to keep an eye on and a risk that they have moving forward. And then markets and healthcare sector as a whole, we're 10 years into a bull market. There's systemic risk there that you can't diversify. And this is in July, it'll be the longest bull market in history. And so, it's a lot of uncertainty in how long this expansion will last. One day you turn on CNBC and they're saying that we're going to be in a recession tomorrow. Next day someone is saying that we could see another couple of years of expansion. I was going to call JP Morgan yesterday and they were saying we could just plateau for a couple of years. But one thing worth noting is this isn't a huge risk. So if we look at some of the long bull markets in history, a lot of them shoot up like this. Like say this is an 8 or 10 year mark. This market has been a lot flatter. And so if there is a contraction, I guess per se, if there is a contraction, it shouldn't be as extreme. I don't think it'll be it won't be a full 2009 risk, but there is still some market risk that we can't get out of the way. That said, no guarantees there. You just say what the next black swan is, but that's just generally what's going on in the markets that could affect our company. So that's about it. Without further ado, we'll get into the valuation. Okay, so the key part of our valuation was the DCF. It was pretty basic, just like the one we did in week 2. Went out 10 years, forecasted future cash flows, and so went out 10 years. We used 5.5% growth rate. We got this 5.5% growth rate from pretty much just taking a weighted average of bear case, base case, and bull case. So, like we said, there's some uncertainty with this company, so we wanted to acknowledge the possibilities. And so we got 5.5% growth, and then we discounted it at 9%. If anything, for the reasons we mentioned on the last slide, where we are in the market, this 9% might have been a little bit high, but we figured best to err on the side of caution, given this company's history. We wanted to just play it safe. Didn't want to get too greedy, trying to value this as high as we could, but rather just acknowledge a safer side of the possibility there. And so we got a calculated value for the company of $8.25 billion. 348 million shares gives us a share price of $23.66 per. And so compared to what it's trading at right now, it's $23.09 and a market cap of $8.05 billion. That said, since then, that was April 30th, it's gone up to $23.44 a share. So, day to day, anything goes. Who's to say what it'll do tomorrow? Who's to say what it will do in a few days? The big day to keep an eye on is May 6th, they're coming out with the earnings. But until then, we have a slightly overvalued, or slightly over the current value, so we have a slightly undervalued right now based on our DCF, 200 million or so. And so that's about it. We did take the valuation one step further though, and we'll get to that on the next slide. All right, so as mentioned, we got a value of $23.66 per share from the DCF. But we did think it was important to account for some type of price earnings in this. It's a very important measure. You buy a company because it makes earnings. Earnings are generally highly correlated with stock prices. And so what we used here was the consensus future price earnings. Got this number from Morningstar. But what we did, it was actually interesting. So they actually posted a net loss last year in 2018. But if you discount the non-recurring costs, so costs that were in 2018, in 2018 alone, they actually did post a profit. And so what we did is we took this, a little bit of math, and then we're able to take the consensus future price earnings again from Morningstar. I think that's a good word to say. It's good as any, as credible as any. And so we took that number and we got a consensus future price earnings of $24.15 for stock value from consensus future price earnings of $24.15 a share. And so how did we weight them? We decided to go 80-20 DCF to future price earnings. This price earnings is in there for a little bit of diversification in our valuation. We didn't want to overweight the work we did on our own because, again, doesn't hurt. There's a lot of uncertainty with this company, so we figured it best to at least get someone else's minds in there a little bit. And so it gave us a target price of $22.76 a share. That represents 2.91% upside from its current price as of April 30th of $22.09 a share. And it is definitely worth noting that they have a highly anticipated earnings report coming out on May 6th for the first quarter of this year. And so there's going to be a couple main areas of focus there. First off, again, is debt repayment. $25 billion of debt. They want to keep paying that off. That's their Achilles heel right now. And so one of the biggest keys to long-term success is getting that debt down. And so that's definitely somewhere people will be looking at. Another one is, interestingly, Craig mentioned that they have the big 7 drugs, but they also have 4 main companies within the Bosch Health Companies line. And of those 4, 2 of them make up 75% of their profit. And so there's going to be a lot of attention on those. And those 2 companies are going to be they're as important as anything, earnings-wise. And they are Bosch and Lomb and Salix. And so when someone opens up this earnings report, they're going to look at debt and they're going to look at those 2 companies, Bosch and Lomb and Salix. And the rest of it is great, but those are 2 areas where they definitely want to post good numbers. And so it'll be interesting to see what happens. I'm looking forward to May 6th coming. And that's about it for our valuation. Right now, we have it priced with a 2.91% upside over its market value. And so it'll be interesting to see how that goes moving forward in the next few days. So that's about it for the valuation. Okay, so to wrap it up, a large part of why this company is still where they are today is because of Papa's leadership. He did a great job of taking the wheel of a company that was really in a pretty bad spot and giving them a decent outlook for the future. As we spent a good bit of time discussing, 2018 profits were stagnant. People are soon to forget this company was once Valeant, and there's some added risk there, even though it's fundamentally a different company. It still was the same company that made those mistakes in the past. That said, stagnant profits aren't necessarily a bad thing because while profits have remained stagnant, debt's gone down. They've divested some of their holdings, and as a result, earnings is going up. It was down the earnings per share was down over $11 per share in 2018, but only 98 cents of that came from the fourth quarter. And then this earnings report coming up in a few days, it's actually projected to be in the green for the first time in a while. And so they're on a terrible spot. And so what they've been focusing on is long-term success. And a big part of that is the debt reduction, as we've mentioned. And then on this earnings report, Bosch and Lomb and Salix can give heavy emphasis, as mentioned on the last slide. And so to wrap it all up, this company is positioning itself for some good long-term growth, profitability, and increased shareholder value, and learning from the mistakes they've made in the past and leaving them in the past. And so that's about it. Thanks everybody for listening. This was a great class. Had a great time on this presentation with my group members, and best of luck to everyone with their future success. Have a great night.